Hello and welcome to today's discussion, the year of credit risk, reducing uncertainty with AI, analytics, and alternative data. My name is Darien Choong, Senior Reporter at Regulation Asia. We are here today amid an ongoing economic slump and continued uncertainty over business conditions around the world. There are concerns among central bankers and policymakers that credit quality could deteriorate as pandemic support measures wind down. In this context, we'll explore how advanced technologies, alternative data, and new modeling tools are helping to provide greater certainty in credit risk assessments. So, joining us on this panel today are Irene, RegTech Compliance Lead at UBS and a board member of FinTech Association of Hong Kong. She brings a wealth of expertise in regulatory technology, private wealth management, and compliance. Irene has spearheaded compliance efforts in UBS, and, welcome to the panel today, Irene.
Hi, thank you. Thanks everyone. Thanks for inviting to this great panel.
Thank you. So next we have George Bosiños, Vice President, Data Science and AI at UnionBank of the Philippines. George is a key man in UnionBank's data science group. His main focus is on AI solutions for the wholesale and MSME banking. Welcome to the panel, Josh.
Thank you, Darien. Thanks, everyone, for having me here.
Okay, yeah. So next we have Brandon Delanty, Managing Principal at Capco, leading the firm's risk, regulatory, and compliance team in Hong Kong. Brandon is also the co-chair of the RegTech Committee at the FinTech Association of Hong Kong. He focuses on projects that seek to improve risk management and operational efficiency using technology. Welcome, Brandon.
Thank you. Thank you very much.
Okay, thanks for joining us today. So before we begin, I'd like to remind our listeners to please use the Q&A box to submit your questions, and we will try to address them throughout the discussion. I'd like to start off with a high-level view of credit risk expectations for 2022. Many central banks and regulators are continuing to encourage banks to provide credit, loan restructuring, repayment deferrals, and other supports to borrowers. So what are the expectations for credit risk in 2022, and what are the expectations from regulators? So maybe we can kick off this question from Brandon. So we will pass it on to Irene and Josh after that.
Yeah, very good. Thank you. So I think when we talk about regulatory expectations, it probably makes sense to talk about different segments of the economy first, right? So I'll tackle the question certainly in the context of SMEs, but it's probably quite different from a wealth management perspective and also, again, from a kind of institutional level perspective. But the general regulatory view with respect to SMEs, I think it's been broadly the same for quite a long time now. And I think that's been that SMEs really need to be supported. And of course, regulation needs to, manage and control risks. However, it's also quite clear that SMEs sometimes feel a disproportionate amount of the negative impact of some regulatory rules. And credit risk is definitely an example of this area, right? So when we look at the issue with respect to credit risk and credit regulation, it's not often that, I guess the issue is not that many SMEs are failing credit worthiness checks or are deemed to be not worthy of credit. The issue is actually just much more simple and fundamental. And the issue is, what reliable information can we actually truly expect an SME to provide us in order to do that check, to say that they are worthy of X amount of credit? And also, how do you not overburden the SME, right? Because as we all know, SMEs are, small and medium-sized enterprises, and in some cases, small enterprises with a very limited amount of resources and a limited amount of time and capability to kind of run around and collect data in order to provide to a bank. So I think during the pandemic, the trend has not necessarily changed direction. I think the direction has remained consistent, that SMEs still are worthy of a lot of attention in this space, that they're still worthy of a lot of support. And the pandemic has actually really deepened that, right? Because when we look at, I guess, who we all know as being the most hard hit in the pandemic is almost invariably the SME sector. And as a result, here in Hong Kong, as in other parts of Asia, we've seen just simply extraordinary measures on government and regulatory authorities' behalf. I mean, amounts of money have been made available to ease credit concerns that would have been considered unimaginable a few short years ago. So I guess in summary, I'd say that the government has rightly extended this amount of support to the SME sector. It's really helping the SME sector, and overall, it's definitely going to reduce the short-term credit risk in that sector. But then that presents a new challenge to banks, because now there's this pandemic pot of money that's available to the SME sector. So how do you truly know the credit risk as a result of these pandemic measures? Because traditionally a bank will have focused on cash flow, for example, as being the primary measure for determining whether an SME is their credit risk score. But with these pandemic measures, it's going to be very, very difficult using those traditional old school methods to determine the credit risk.
Okay, so Irene, do you have anything
thanks,
to add?
Brandon. Yeah, maybe this is a very good start off and kick off of the topic here. And I quite agree with Brandon that actually the credit risk management or whatever principle and regulation in Hong Kong, at least from my lens, I think it is quite consistent and quite static, because what I have observed, the rules are there and the principles do not change. And pretty much on how we do the risk management by the firms is pretty much quite reliant on all those regulations, supervisory manuals that was set out quite some time ago. But as you have mentioned, credit risk is quite highly dependent on demographics, economic events, environments, and also all these sudden catastrophe events. So like pandemic, like politically driven, and it will have increasing risk to the bank itself who offer the loan to the client, and also on the client itself if they have a different segments. So it is quite dependent of how bank approach or the financial institution approach to the different client segments. As Brenda mentioned, that could be SMEs, micro SMEs, and could be high net worth and the institutions. So starting from the bank that I work for, basically we are focusing on the high net worth. And though we understand the credit risk management, it's even more having more opportunities for these SME firms. Even though the global banks like us are not focusing on the SME, but we still see a lot of opportunities and the pains how the bank would step into that SME lending and try to mitigate the kind of risk that being over-hedged, over-lending as part of our lending book. So we have been doing a lot of like trend analysis on the client's level, and we are doing a lot of gap analysis comparing with the jurisdiction, different jurisdiction, how the industry and the sectoral clients operate and how they would need a loan from a global bank like us. And we see quite a big shift of the trends. In the past, they are quite collateral based, highly collateral based. So it's just simply give us collateral, whatever is property or some of the investments, and then capitalize in our bank and then get a loan, and that's it. But then there are a lot of disruptive and innovative lending products that we can see in the market. Can be some of them is secured or non-secured, or some personal guarantee, or even they have idea or concept on some innovative ideas, but they need money to invest and seek for some direct investment as a kind of loan product. So shifting from a traditional loans to some innovative lending or P2TP lending, we can see. Even we are offering maybe highly focusing on structured lending or some sophisticated lending, but we do see well for some of our executive clients. Could be the second generation of a tycoon. They have their own startup, and then they are not as sophisticated and large large institution like the family office, but they still need some loans. And based on the relationship we have with them, we are still thinking of how to provide some of the disruptive loan to them. Even we are focusing on a high net worth client. So we do see the kind of push or pull factor is not really coming from the regulations, stringent regulations requirements. It's more from the environment, the business demand, and sort of the risk factor that's driven by them as well. And maybe later on, after Josh mentioned more about how they look at we can talk about more about how data would constitute the credit risk assessment as well.
Yes, okay. Thank you, Irene. So, Josh.
Well, Darien, Brendan, Irene, from the Philippines point of view, what we're seeing is some positive impact of the pandemic with regards to the support that our central bank has been extending to accelerate financial inclusion. Many of our MSMEs, just like any other parts of the world, have been really affected by the crisis. And so even at the earlier part of the pandemic, the central bank, the regulators has been working on some programs that can really support the MSME sector. And in fact, earlier this year, I'm quite happy with this announcement. They have announced as they encourage the banks to leverage non-traditional consumer data to aid in credit scoring. Yeah, and I believe this is really a big step for us, for a country that is very traditional in general in terms of extending lending services. We've been heavily reliant to the traditional ways of lending, and I'm really, really happy hearing this encouragement from the regulators to push us to use more alternative data for credit risk management. Although for UnionBank in the Philippines, where I'm working, we've been exploring alternative data for quite some time already. I'm quite proud of that. Getting such encouragement from the regulators is just simply telling us, just continue accelerating what we've already been started.
That's pretty interesting from like two different markets and how you guys are seeing this this trend coming. So I'll continue with Josh. So how do you define alternative data?
That's a good question, Darien. Well, the traditional way of lending is typically when banks are asking, certain information, documents, data that would satisfy the 5 C's of credits, as the risk experts call it. But in the Philippine setting, it would be really very challenging for many MSMEs to provide such documentations, such data, as majority of our MSMEs are unbanked. For example, I know a friend who's been really struggling financially during the pandemic with all the lockdowns. So she started selling food that she prepares from her kitchen and sells it through the free online channels, Facebook, Instagram, Twitter. And since then, she's been really earning enough to survive the crisis, but she's not really a formally registered MSME. And so she doesn't have business registration. She doesn't even have a bank account that can demonstrate financial capacity of the business. So these are the typical documentations that the banks require when you want to have like some business loans. So, but if she wants to grow her business and would need to get a loan, she will never be granted one with that situation. So the idea of alternative data is to move away from these traditional underwriting requirements and instead, leverage on data that, number one, the consumers can easily provide. For example, identification cards, for sure they have one, What else? Address, for sure. I'm sure they also have one, What else? The name of their business, of course, is seen in the social media platforms, for example, etc. And second is we can make use of other data sources, whether it's a publicly available one or something that you can acquire by paying, and relate this data to the ones provided by the customers. The freely and publicly available ones, for example, macro and socioeconomic data that you can typically get from the government websites. Another example, the paid ones that we typically get from good companies like Google, this Google Map APIs. We are leveraging on in their Google Map elevation data, where it's giving us how elevated one particular address is. If you just give an address as an input, and it can return to you the result from that particular location. Now, I wanted to talk more about that particular example, but maybe I'll save that for later. But yeah, that's how we define alternative data, Darien.
Okay, thanks for that, Josh. So, asking also, like, what are the regulators' expectations of banks in the collection of this data? So, Brendan,
Yeah,
you
so
can.
yeah, happy to take that one. But I mean, just to add on to Josh's comments as well, right? I mean,
Yep.
you're talking about how much cash only businesses there are in the Philippines, and when you go to Indonesia, they say the same about Indonesia, and as many of us know, how many cash only businesses are there in Hong Kong as well, right? It's like actually a Pan Asian phenomenon almost, and it really. Because you always hear governments and regulators saying that this sector is actually the backbone of the economy. It's critical that it's served and served properly from a financial inclusiveness perspective. So it's great to see someone like UnionBank doing this, and hopefully it can pave the way for others to copy and paste their methods, I think, or learn from their methods, I probably should say. But yeah, Darien, going back to your question, I think and it's also interesting the balance that we have on the panel with Josh. Josh, I believe you're a data scientist, right? And
Yeah.
then Irene, you're in compliance advisory, and then Darien, I think your question was, to what extent, what are the regulatory expectations around how we handle data, and it's not impossible to imagine that Josh will give you one answer and Irene will give you a slightly different answer, because when we're talking about artificial intelligence, as we all know, it thrives on huge amounts of data. But when we talk about credit risk, we're talking about people, particularly in the SME sector, we're talking about people's most private, most sensitive data that they want protected to the maximum, right? Their financial statements, their very personal information, right? So, relaying this in a credit risk context, if I was to say, hey, give me total unfettered access to your data and I'll give you a very accurate credit risk score, you're going to say no. That's not reasonable. I don't want to hand over all of my data. So there has to be this balance between what the data scientist might want to, I guess, create a perfect model, and what compliance advisory will say is actually permissible from a data privacy perspective. So I think we always need to be mindful of the privacy principles, and not over requesting information from clients, and not getting or retaining more information than is necessary. So it kind of echoes back to Josh's points in terms of what UnionBank is doing, and actually taking data that's already in the public sphere. It's not actually getting data from the client. It's using data that's already publicly available, that the client has already put out there. So that's one interesting nuance in terms of how to do this. I think another kind of regulatory aspect of this is also just about how not to create a centralized store of credit risk data about every individual. You sometimes hear about the term honeypot. We don't want to create a centralized honeypot, which would be a magnet for hackers in terms of compiling one centralized pot of everybody's credit risk data, right? So, and I think that's kind of echoed in some of the developments that we see in the Hong Kong regulatory space as well.
Okay, so I understand that alternative data is mostly applicable for digital type business models, but in many cases, some industries remain very paper-based. So is there a way to bring these types of sources into the data set? I guess maybe who wants to take this question?
Yeah, maybe I can start first.
Yeah.
So I want to echo with how we define data, right? So lots of data in the market, and we are not lacking of data. We have too much of the data, and we need to identify what data is useful and constitute a meaningful credit assessment. Then for banks like us, we have two main types of loans. So for the first loan is pretty much quite standardized. So it's about collateral based and based on the client portfolio, risk assessment, and they may have a standard kind of lines, credit lines for their loan to repay for or do the margin investment. And the second type of loan would be more sophisticated and structured loans. And the credit assessment could be very bespoke and tailor-made, where we will need to do a 360 review of this particular client and relationship with us. And we do not just collect data that is conventionally in our bank. We may need to do some questionnaires, qualitative review, qualitative kind of interviews to see the repayment ability and creditworthiness, and also to decide what should be the strategy in offering such a loan. And at the end of the day, because of this credit risk analysis, we could come up with an alternative solution for the client instead of a particular loan product. So it would be come up with a lot of interesting ideas. And those data is actually very, very tailor-made to the particular client scenario. And like what you mentioned, it could be a combination of different sets of data in a virtual format, in a machine readable format. It could be very manually from some different financial statements, papers. And to be honest, for those structured loans product, it is not yet really fully utilized on those alternative kind of credit data, just because those may not be forming the majority part of the credit assessment, because this is just a supplementary information, I would say. And we do see a lot of different interesting data that is happening or creating in the market. Maybe I provide one example so that I just throw a stone on the word refer to see whether you have any feedback. So some of them is about a behavioral kind of questionnaire or test, to ask the client to fill out a lot of different psychological tests and to see the willingness to pay or whatever. And I also heard of some of the school of thoughts. They use the different astrology kind of methodology, like feng shui, like 紫微斗数, that is that kind of predictive data to test whatever the types of person that of this client, and whether they would have any hidden characters that they are not willing to pay. So this would be some interesting data, maybe not in a mainstream credit assessment, but from something that we can create a better storyline or a better portfolio for us to approve a loan product to the client. And you can see that like respond to Darien questions, how to like transform all this data into a utility so that we can reuse it or do a trend analysis is really a pain for maybe most of the banks. And we will need some technology tools to transform all that so that we can translate into a more meaningful tool for future credit assessment.
Thanks, Irene. This is very interesting. My first time hearing using feng shui, 紫微斗数. This very oriental approach. I think this is very unique of Asia to to do these credit assessments. Yeah. So back to George again. So maybe can you share with us how UnionBank has been able to use alternative data in the credit scoring process?
Okay, Darien. So in UnionBank of the Philippines, we've started offering this MSME business loan program, which is basically an unsecured short-term loan since the beginning of, I think it was 2020, which is actually a perfect timing with the pandemic crisis going on. At the beginning of the offering, we didn't have any machine learning-based model available for credit risk scoring. And so we leveraged on expert models that was designed specifically for this product. Now, for us to be able to build our own machine learning-based models, we need to, of course, start collecting more data, and not just actually more data, we need to collect performance data of the actual loan. So things took us some time to really come up with enough samples to train the first version of our alternative credit scoring model. During the first attempt to build the models, we've started by introducing, some alternative data such as the one I mentioned earlier, macro and socioeconomic data. To give you an example, the population data in the area where the business is located. We also introduced data from the Google API. It's a paid API, such as the Google Maps data. I mentioned this also earlier, the elevation data. It's quite interesting, actually. I'd just like to share with everyone. When we introduce the elevation data to our models, where the models are telling us that there is a positive correlation between the elevation of where the business is located and the risk of loan default. It's quite fascinating, actually, interesting. And we did a couple more experimentations where, as we progress, we've been introducing new alternative data. For example, we've recently introduced a crime index data, which I believe you'll not be surprised about how crime incidents within the area of the business affects the risk of default, no? And some ongoing and future experimentations about the integration of more alternative data into our models. For example, geospatial data. Yeah, I'm seeing there will be a lot of impact with the geospatial data, but it's still a work in progress, so we cannot share something valuable for you at the moment. We're also exploring internet footprint of the businesses. So you see, whenever we see an opportunity to introduce new alternative data, whether it's a feng shui data, astrological data, we experiment with it because at the end of the day, it may or it may not be relevant in measuring credit risk, but we'll never know unless we try an experiment, no? So this is a never-ending process for us, Darien.
Thank you, Josh. So maybe I would just also like following up on this. So for the benefits itself, so it's like what the expectations when you move on to an alternative credit scoring model, and were this achieved, and that what benefits are you seeing so far?
I'm sorry, Darien, could you repeat the question?
Sure. So what are the where the expectations when you moved into an alternative credit scoring model? So and were these achieved? So so share with us the benefits you're seeing so far.
Okay, so whenever you introduce an alternative scoring model, of course, your expectation is to address the credit risk. For UnionBank of the Philippines, we were committed to accelerate our financial inclusion in the country. So we've been really putting resources to support initiatives with regards to this. I've mentioned earlier that we've started that MSME business loan with just an expert model. Where during that time we were really struggling to get more bookings because we were only having an approval rates of between 20 to 25%. That's quite very low. We're really rejecting a lot of applications during that time. But when we started to introduce for the first time alternative credit scoring, our approval rate increased, by more than double, reaching to more than 50%. While concurrently reducing delinquency rate as we progress with the new versions of the models. And we're seeing, just to share with you, we're seeing some really good results with the recent models where initial delinquency rate went down to 19% for the bookings with the latest version. That's very far from the expert model performance of more than 36%. All right. Wow. And we would like to maintain that kind of performance, even surpass that. So we're gradually would like to reduce default rates while, of course, increasing approval rates to accommodate more applications. And that's why we don't stop from experimentation and trying out new alternative data, trying out new algorithms.
Thank you. So Irene, so there's a question from the floor just now, basing on what you said about feng shui. So there's this question coming from the floor saying, what are the basis for this kind of credit assessments? So the reader was asking, so whether this will create very subjective assessments.
Yeah, maybe thinking from this way. So why do we have a development of alternative data? It is about, like Josh mentioned, because of the rising of the financial inclusiveness, we have a lot of unbanked population, whether they are the sole owner of a shops or could be a KOL that they have only one person owning a business model without even a legal formation, or even is owner of a Tmall store, whatever, like a very micro kind of business model, or even an individual. So the big banks would not able to offer the loans to them, because on the regulatory baseline, we need to obtain a lot of know your clients kind of information. So we need to have some kind of all-rounded understanding investigation of these individuals. And the particular is about bank statements, or about whether they have any credit data in the other financial institution, and also do they offer a kind of reliable kind of information that on a basis so that we can provide loans. So these type of things we are not worried about, because we have traditional methods to assess the creditworthiness. But for those individuals, financial inclusiveness, we don't have any reliable data at this front. So that's how alternative data comes in as a supplementation. So those data could be like what Josh mentioned. It's like the shopping pattern of some of the like Tmall's, could be a social media data, and could be a lot of stuff. And then think about this way: they may have a useful wallet, like in WeChat, a wallet, and some of the wallet that they would do payments because they are owner of a small business. So they usually have that like PayPal or WeChat wallet payment, and all those data would be in that wallet, which constitute the different aspects of his all walks of the life, like including like medical records, shopping records, merchandise records, purchasing procurement records, or even the entertainment records, whatever data you manage. So those are the behavioral data, and you can make use of that data for some of your prediction or the creditworthiness. So what Josh mentioned is really quite insightful for me. So these type of data could be very experimental and maybe form some part of your credit scoring. So feng shui could be one of the environmental scientific angle to look at it, or astrology based on the day birth and the time of birth of a particular person to predict some of the characteristic of personnel. So psychological test is one of the aspects that you can name it, but somehow when the client is responding to the questionnaire, they can be preset, predefine a kind of assumptions, or the client can fake about the answers. But with the birth data, could be some of the stereotype of characteristics can come up for your prediction. Could be very meaningful. You could be very interesting to find out some of the different types of characteristics is quite in common for those person in that age, give birth in a particular time, or in a particular time zone, or in a particular place. Then you will come up a meaningful, surprisingly prediction for your credit assessment. So back to the question, is it subjective or objective? So subjectivity is a comparison, right? How you compare with the different sets of data. However, if the alternative data is massive enough, and these additional elements would form an interesting, maybe your assessment to how you look at your client. And I would see this environment or these trends will be evolving, so that you will have a different data utility builds up, and then even you have a cross-sectoral or cross-discipline kind of development of alternative data. As you see, as name it, alternative data could be unlimited in definition. So whatever is alternative, then that data should come into play for the credit assessment. It may not be meaningful at the last, but at least you have that experiment, and also you have the use case for you to move forward. Yeah, I think that's the beautiness of how it constitutes the whole industry. Yeah.
Thanks, Irene, for that. It's very interesting indeed. So, to Brandon, so how do you address regulators' expectation for explainability when using alternative credit scoring models?
Sorry, can you repeat the question? How do
Okay,
I cut out a little bit?
I have two questions actually for you. So the first one, maybe can share with us, how do you address regulators' expectations for the explainability when using alternative credit scoring models? Yeah.
So it's probably a less interesting question than Irene got about feng shui, so that's a pity. But it's also a much more difficult question, because, to be honest, I'm not really sure I've got a very precise answer for you there. But maybe I can talk about a little bit of the I guess interesting developments in the space and some of the challenge, because it is the right question, and I think there's a lot of time and attention that is being paid to addressing this question, right? So I think a lot of the new and innovative credit risk models that we're seeing kind of come to light and in development at the moment are around federated learning models. Federated learning models, and also using kind of privacy enhancing tools, what I'll call privacy enhancing tools, right? So in terms of what a federated learning model is, just very briefly, it's essentially an assessment or a methodology or an algorithm which a bank will design in order to perform an assessment. And what's different about it from traditional machine learning techniques is that you send it, so you send it to a local client, and it can run over localized data sets without interacting with a centralized database. Sorry, I shouldn't say it doesn't interact with a centralized database. It interacts with a centralized database, but it doesn't share the underlying client data, which is, like we said before, right, highly sensitive, highly personal information, financial information. So in terms of, well, you asked a very good question, right? Because how do the federated learning models, how do you get that security of the audit trail and the robustness of the credit risk score when you're talking about a federated learning model? And that's a challenging question, because essentially what happens is, with the federated learning model, a bank will send the model or send the algorithm to the client. It runs over the client's data set. The client retains their own data, and what the bank receives is a very simple credit risk score for the client. Now, how do you justify the output of the score? Well, you're essentially relying on data scientists without being able to put your finger under a piece of information which underpins it, because you're going back to that initial problem which we spoke about, which is getting the benefits of machine learning, getting the benefits of artificial intelligence, which requires huge amounts of data, but also protecting the customer's privacy. And then when you deploy these methods, you are somewhat reliant on very technical responses to justify your output of a credit risk score. So one practical workaround, which I think is very, very common, obviously, in terms of the immediate, let's say, the development stage of federated learning models, is putting these into parallel runs. And I feel like Irene was maybe touching on this point as well with some of the feng shui stuff, actually. So it's about designing this federated learning model, putting it into a parallel run over dummy data, and justifying the response in comparison to a bank's traditional method. So you can over time see and compare the two models, the traditional method and the federated learning model, and say, well, this is the difference in score, and you can underpin it looking at the dummy data and saying this is the reason why, and that can give you quite a good degree of confidence over whether your model is robust and accurate and where it should be. So does that answer your question? I think it probably does.
Yeah. Well, thanks a lot. So I think following up, another question for you. So I understand in Hong Kong, there's a plan to actually launch a new platform this year for the credit reference agencies. So,
Right.
Can you share with us a bit more about this initiative and how it changed the credit risk landscape?
Yeah, so the Hong Kong Association of Banks is in the process of launching, like you said, a multiple credit reference agency platform. And what that's going to do is it's going to create one platform where all banks can access, and they will essentially create a platform or a marketplace for credit reference data. I think it's really going to shake up the market in this space and lead to much more competition. It's going to lead to potential new entrants. I think it also moves away from some I think, very publicly expressed concerns in Hong Kong that there won't be that there, with the current model, let's say, there's a single point of failure, because I guess the market has almost naturally resulted in a kind of monopoly position. So this platform will move away from that and open up the market in a space that hasn't kind of seen or experienced much change in recent years. So I think in terms of where they are at the moment, there is a lot of development work that's being that's underway with multiple banks. I believe they'll probably be starting their system integration testing, so their connectivity testing with the new platform quite soon. And the Association of Banks, I believe, is working on their operating procedures at the moment as well. And this should all be kind of live within by the end of 2022, approximately, I guess.
Okay, thanks, Brandon. So, Josh, maybe you can share with us a bit more about the models that you are using with alternative data. So, how advanced are these the analytics you use in the credit scoring process as well?
Okay, so our models, Darien, are machine learning based, and we follow certain internal and quality standards in terms of model development. We also have our own multiple data science platforms that we use to experiment. So it's like, imagine it's like a laboratories for the data scientists to work on. Our models are also using algorithms that are explainable as we promote explainable AI. That's very important for us, especially in the credit risk modeling. So, and in terms of data, as I've been mentioning, we are heavily reliant with alternative data. So we've been really putting a lot of effort and resources in developing internally tools that extracts, transforms, and loads these externally available data, and we make it available for our data scientists to let them experiment on this data. Maybe going back to the question earlier for Irene, whether using alternative data is something subjective. Typically, when I explain the answer to my stakeholders, I always explain it short and sweet with this kind of explanation that there are underlying customer characteristics and behaviors that are highly correlated to a good credit outcomes, and concurrently, there are underlying behaviors, characteristics of the customers that are highly correlated to the bad credit outcome. Now, the question is, what are those data? What are those characteristics? What are those behaviors? That is when I come in as a data scientist. I come in and use the data science approach to find those patterns of data that can explain the high correlation between the good credit outcome and the bad credit outcome. Yeah, it's just looking for the patterns. We even have our own data sharing platform, Darien, we call Parlayan, to solve challenges in terms of data sharing across the BU. So it's really, we're trying to solve that one so that the data sharing across business units and the developers of the models as well is covered. And well, we are a group of 100 data professionals across the Aboitiz Data Innovation Group. I'm just part of a bigger group where it consists of data scientists, data engineers, data architects, privacy officers. We even have our own behavioral scientists coming from UnionBank and all other areas of Aboitiz, which is actually created to support mostly the financial services, of course, which is the UnionBank. And with this, I would really say that really advanced in terms of operationalizing AI, especially in the areas of credit risk management.
Maybe if I could just add on to that, just from there were some interesting points that you mentioned, and it's great to hear how far it's come and how much it's become a science, right? When I was in university, I worked for a semester just as a volunteer in Peru with a micro lending organization. What they were doing was really unsecured loans and like micro of the SME sector, let's say. And they were, part of my job was as a credit officer to go to these really rural villages where, certainly they wouldn't have had a business registration certificate or anything of the kind. And what people who I worked with told me was that they had one informal rule, which was by no means a rule, and they weren't really supposed to talk about it, but this was what they had learned from their experience. And it was, we lend to customers with one type of data attribute, and we don't lend to customers with one other data attribute, and that's gender. We only lend to women. And when we lend to women, we see massive increases in terms of all our credit risk metrics. And when we open it up, they drop down, they really plummet as well. And from their perspective, you know, this might kind of like strike the wrong chord with people hearing it for the first time. But from their perspective and from the organization's perspective, the question is very simple. Do we lend or do we not lend? Because we can't afford to lend to everybody if we're going to have these bad credit risk management metrics. We have to abandon and exit an entire market that we should be serving, that's helping that community, or else we can apply this metric and find our good customers within this underserved market.
Yeah, maybe with the inspiration from Brandon and Josh, with this group here, shall we have a pilot or experiment to put feng shui data into some data science so that we may have a big project, a unicorn?
This would be some education for me. I can say that my knowledge on this topic is close to zero, but happy to.
Yeah, I think that'll be a very interesting project. I think this kicks off. So yeah, I think we have only for time a couple of minutes left. So Irene, so you work in a very large global bank. So the challenges of using alternative data is very different as what you shared before, just earlier, the feng shui, you know. Yeah. So can you share with us the current approaches being used and some of the pain points that you have faced?
Yeah, I would say that the current credit assessment model for the bespoke and sophisticated kind of loan product is quite hybrid. So we leverage off a lot of data in a database, how we obtain from the client, because we have a very long history and relationship with them. So they have already the trading pattern background with us, and we know them very well, and we know them even well enough to understand how they react to the environment, and also the other relationship for the other banks or whatever as well. So some of the information is provided by the client, and some of the information, as we will do some kind of background searches, and we have the database on the particular client. So it is a combination of the utility and system that we obtained, and also we will do some ad hoc search from a menu kind of thing. So for some sophisticated loans, we do formulate a very informative credit analysis. So it could be a kind of literature review, a sectoral review, client review, and for information that we can form some justification why we lend or not. So I like what Brandon mentioned. The key question is that whether we will lend, right? So be it is a secure loan or unsecured loan. For unsecured loan, we need to form some basis on why we lend and why we not lend. So this is kind of credit assessments of how the bank look at it. And the considerable factors could be driven by the regulators from the requirements, and also from different kind of risk appetite that the bank put on it, and also highly on the risk appetite as well. So if in the environment that we face, we found that there's a more risky environment or elements on that particular sector, we will reduce a little bit of the appetite. So it is quite a dynamic, and it's not a static approach, but respond to the questions. So it is a hybrid model for banks like us, and we love to utilize data science, statistics, and all that. So alternative data is something that we try to see how to make an interesting element in our traditional credit assessment, but not something very much a majority or mainstream of our methodology.
Okay, with that, I think we are out of time. Thanks again, Irene, for the insights. So I would like to thank our panelists again, Irene Lee, Brandon Delanty, and Josh Bosiños. Thanks for the interesting discussion today.
Thank you. Cheers. Thank you.
Thank you.
Thank you.